$4 trillion recovered in 30 hours. Gold surged 11% from its bottom. Silver exploded 20%. While the majority was selling in panic, someone else was buying everything. This wasn't a recovery. This was a transfer. The question isn't whether the metals markets are manipulated. The question is who engineered this exact sequence? And more importantly, what are they preparing for next? Because what happened in those 30 hours is about to reveal something far more critical about the system you're operating within. Welcome to Silver Radar. If you've been watching these markets long enough to remember when stability actually meant something, when a handshake carried weight, and when financial engineering hadn't yet replaced fundamental value, then you understand why you're here. This channel exists for those who prefer clarity over noise. If that resonates with you, consider subscribing. We'd value having you with us. And we're curious. Where are you watching from today? Let us know in the comments below. Now, let's examine what really happened in those 30 hours. 30 hours. In the span of time most people spend sleeping through a weekend, the precious metals markets experienced what can only be described as a surgical wealth transfer event. Gold climbed 11% from its intraday bottom, reclaiming the 2,880 threshold. Silver surged nearly 20%, breaking back above $33 per ounce. Together, these movements represented approximately $4 trillion in restored market capitalization. But to call this a recovery would be to fundamentally misunderstand what transpired. This was not organic market behavior. This was not investor sentiment shifting based on new information. This was the visible manifestation of something far more calculated. A sequence that has played out repeatedly throughout financial history, yet somehow manages to catch the majority off guard every single time. The numbers themselves tell only part of the story. Gold had fallen from its recent highs, shedding value in a cascade that resembled panic more than price discovery. Silver, known for its volatility, experienced an even more dramatic collapse. The combined drawdown approached $11 trillion in market capitalization, wealth that appeared to simply evaporate from balance sheets, portfolios, and exchange accounts across the global system. Then came the reversal. Not gradual, not tentative, not accompanied by the typical consolidation patterns that characterize genuine investor confidence returning to a market. Instead, what occurred was velocity, vertical price movement on expanding volume, the kind of price action that forces observers to ask uncomfortable questions about market structure itself. Consider the technical sequence. During the decline, sell orders overwhelmed bid liquidity at key support levels. Stop-loss orders triggered in cascading waves. Margin calls forced liquidations. Algorithmic systems detected weakness and accelerated the selling pressure. This is the anatomy of a forced liquidation event, where holders are systematically removed from their positions, not by choice, but by the mechanical constraints of leverage and risk management protocols. The majority of this selling came from predictable sources. Retail participants, watching their positions decline rapidly, made the decision to exit. Exchange data shows significant outflows during the bottom formation. Social sentiment analysis reveals panic, frustration, and capitulation. Search trends for terms like gold crash and silver collapse spiked precisely at the lows. This is human behavior under financial stress, understandable, predictable, and consistently exploited, because while retail was selling, someone else was buying. The reversal began with unusual volume appearing at specific price levels, large block trades, dark pool activity, the kind of order flow that doesn't come from individual investors making emotional decisions. This was institutional scale. This was strategic positioning. This was capital that understood exactly what was happening. Because capital at that scale doesn't react to markets. It creates them. Within hours, the trend reversed completely. Gold began climbing. Silver followed with even greater momentum. Short positions that had been established during the decline suddenly found themselves underwater. Covering began. As prices rose, more shorts were forced to buy. This created a feedback loop, the short squeeze that propelled prices vertically in the opposite direction. $4 trillion, 30 hours. The speed of this reversal is what separates it from normal market cycles. Genuine recoveries, driven by fundamentals, take time. Information disseminates, confidence rebuilds gradually, investors re-enter positions cautiously. This was none of those things. This was a spring being compressed, then released. The question that every serious participant should be asking is not whether this was manipulated. Market structure itself enables this kind of event through leverage, derivative exposure, and concentrated control over price discovery mechanisms. The question is, why now? Because events of this magnitude don't occur in isolation. They occur when larger forces are positioning for something beyond the immediate price action. They occur when strategic capital is rotating ahead of broader systemic shifts. They occur when those who control significant resources are preparing for conditions that haven't yet materialized in public awareness. The $4 trillion reversal in 30 hours, is not the story, it's the signal. And what it's signaling is what we need to examine next. Markets at this scale do not move by accident. $4 trillion recovering in 30 hours requires more than sentiment, more than news flow, more than retail investors suddenly changing their minds about precious metals. This magnitude of capital movement requires planning, positioning, and institutional coordination that operates far beyond what appears on public exchanges. The question isn't whether manipulation exists. The question is, who has the capacity to execute it, and why did they choose this precise moment? Begin with the preparation phase. Weeks before the crash, derivative markets began showing unusual patterns. Options positioning tilted heavily toward downside bets. Futures contracts accumulated in concentrated hands. These weren't retail traders speculating on direction. This was strategic capital building the infrastructure for what was about to unfold. The decline itself revealed the coordination. When gold broke key support levels, the selling accelerated with mechanical precision. Silver followed with amplified volatility. The timing, the intensity, the specific price levels targeted. None of this reflected organic market behavior. This reflected pre-positioned algorithms triggering in sequence, designed to cascade through stop-loss orders and margin thresholds. Then examine who was present at the bottom. Large block purchases appeared immediately. Not tentative buying, not gradual accumulation. Institutional scale orders that absorbed the panic selling and established positions at artificially depressed prices. Dark pool activity surged precisely when public exchanges showed maximum fear. This is the signature of strategic capital that understood the sequence before it happened, because they created the sequence. Central banks have been accumulating gold at record rates. China added to reserves for 17 consecutive months before this event. Russia continues diversifying away from dollar-denominated assets despite sanctions pressure. Middle Eastern sovereign wealth funds have systematically increased precious metals allocations. These aren't investment decisions. These are monetary policy decisions disguised as reserve management. The Western banking system operates differently, but with equal calculation. J.P. Morgan, the institution with documented history of metals market manipulation and billion-dollar settlement fines, maintains concentrated positions in both gold and silver markets. Their trading desk activity during volatile periods consistently shows patterns of selling into strength and buying into engineered weakness. COMEX data reveals concentration that defies free market principles. A handful of commercial traders hold short positions representing months of global production. This concentration creates the structural ability to influence price through derivative leverage rather than physical supply and demand. When volatility is desired, these positions can be used to trigger cascading liquidations. When accumulation is desired, the same mechanisms reverse. The London bullion market operates with even less transparency. Over-the-counter trading, unallocated accounts, and paper claims that vastly exceed physical inventory create an environment where price discovery has little relationship to actual metal availability. This structure enables large players to suppress or elevate prices based on strategic objectives rather than market fundamentals. High-frequency trading firms exploit these structural vulnerabilities with microsecond precision. Their algorithms detect liquidity gaps, front-run order flow, and amplify volatility in whichever direction benefits their positioning. During the 30-hour reversal, HFT activity spiked dramatically, accelerating both the decline and the subsequent recovery beyond what fundamental buying or selling would produce. Options expiration timing provides another clue to coordination. The crash occurred within a window where maximum pain for retail options holders coincided with maximum profit for those writing the contracts. This isn't coincidence. This is mathematical optimization of wealth extraction from uninformed participants to informed market makers. Clearinghouses played their role through risk management protocols that forced liquidations at the worst possible prices. Margin requirements increased precisely when positions were most stressed, compelling holders to sell into falling markets. Then, as prices reversed, those same requirements relaxed, allowing institutional buyers to leverage their newly acquired positions. The wealth transfer mechanism becomes clear when examined systemically. Retail participants, holding physical metal or exchange-traded products, watched value decline and made emotional exit decisions. Institutional participants, operating with superior information and structural advantages, accumulated those same positions at distressed prices. Within 30 hours, trillions in notional value moved from weaker hands to stronger hands. This pattern repeats throughout financial history. The 2013 gold slam, the 2020 March crash, the 2008 forced liquidations. Each event shares common characteristics: coordinated selling pressure, retail capitulation, institutional accumulation, and rapid reversal once transfer is complete. But this event carries different implications because of its timing. Global debt has reached levels that make traditional monetary policy increasingly impotent. Currency debasement accelerates across all major economies. Geopolitical fractures threaten the dollar-centric system that has enabled Western financial dominance for decades. In this context, the $4 trillion reversal signals more than tactical trading. It signals strategic positioning ahead of monetary regime change. Those who control significant capital are not buying gold and silver as investments. They are buying them as monetary assets for a system transition they see approaching. The volatility itself serves multiple purposes. It shakes out weak holders. It generates trading profits for those positioned correctly. It maintains the illusion that precious metals are too risky for serious portfolios. And most critically, it allows massive accumulation without triggering the price discovery that would occur if institutional buying appeared transparently in public markets. Who orchestrated this? The answer is not a single entity, but a network of interests that benefit from the current system while simultaneously preparing for its evolution. Central banks protecting their monetary relevance, commercial banks extracting profits from volatility, sovereign wealth funds diversifying against currency risk, all operating with information advantages and structural capabilities that retail participants can never access. The 30 hours were not chaos, they were choreography, and the performance is not yet complete. The $4 trillion reversal is not the story, it is the alarm bell. What happened in those 30 hours was not an isolated market event. It was a symptom of something far more profound, a financial system approaching the limits of its structural viability. The violence of the movement, the speed of the reversal, the magnitude of the capital involved. These are not characteristics of healthy markets functioning normally. These are characteristics of a system under extreme stress, attempting to maintain an appearance of stability while its foundational architecture begins to fracture. The signals have been building for years. Most observers miss them because they focus on individual data points rather than the interconnected pattern. But when examined systemically, the warnings become unmistakable. Start with the Treasury market, the bedrock of global finance. For decades, U.S. government debt has been considered the ultimate safe asset, the benchmark against which all other securities are priced. But that market now exhibits behavior that would be considered crisis level in any other context. Liquidity has deteriorated significantly. Bid-ask spreads widen during stress. Primary dealers struggle to absorb new issuance. Foreign central banks, once reliable buyers, have become net sellers. The Federal Reserve finds itself trapped in an impossible position. Inflation remains elevated despite official narratives suggesting it has been tamed. Real inflation, the actual cost increases that businesses and consumers experience daily, continues to erode purchasing power at rates far exceeding government statistics. Yet raising interest rates further would collapse the debt structure of the entire economy. And lowering rates would accelerate currency debasement and inflation expectations. This is not a policy dilemma. This is a system design flaw reaching its mathematical conclusion. Repo markets provide another critical indicator. These overnight lending mechanisms that ensure liquidity throughout the financial system have experienced repeated dysfunction. Rates spike unexpectedly. Collateral requirements shift unpredictably. The Federal Reserve has been forced to intervene with increasing frequency to prevent funding freezes. This is the plumbing of the financial system, and it is showing signs of blockage. Corporate debt levels have reached unprecedented heights. Companies borrowed heavily during years of artificially suppressed interest rates, using cheap capital to fund buybacks, acquisitions, and operations rather than productive investment. Now that debt must be rolled over at significantly higher rates. Refinancing walls are approaching. Default risks are climbing. The corporate bond market, once a stable income source for institutional investors, has become a minefield of credit risk. Consumer debt tells a similar story. Credit card balances at record highs, auto loan delinquencies rising, student debt burdens crushing an entire generation's wealth formation capacity. Household savings rates have collapsed. Discretionary spending increasingly relies on credit rather than income. This is not an economy experiencing genuine growth. This is an economy running on borrowed time and borrowed money. Commercial real estate presents perhaps the most visible crisis. Office buildings sit empty as remote work becomes permanent. Retail spaces close as consumer behavior shifts. Property values decline while debt obligations remain fixed. Regional banks with heavy commercial real estate exposure face mounting losses. The crisis is not theoretical. It is actively unfolding with implications that will cascade through the entire banking sector. And the banking sector itself carries derivative exposure that dwarfs the real economy. Trillions in notional value of complex financial instruments interconnected across institutions, creating systemic fragility that regulators acknowledge but cannot effectively address. The 2008 crisis revealed these vulnerabilities. Nothing fundamental has changed except the magnitude of the exposure has grown larger. This is the everything bubble. Not just stocks overvalued, not just bonds mispriced, not just real estate inflated. Everything simultaneously stretched to valuations that can only be sustained through continued monetary expansion, which creates the very inflation that threatens to undermine the entire structure. Now, layer geopolitical shifts onto this financial fragility. The BRICS coalition, Brazil, Russia, India, China, South Africa, and expanding membership, actively constructing alternative trade and payment systems designed to bypass the dollar. This is not rhetoric. This is infrastructure being built. Oil trades settling in yuan. Bilateral agreements using local currencies. Central bank swap lines that exclude Western intermediaries. De-dollarization was dismissed as impossible just years ago. Today, it is measurable, accelerating, and fundamentally threatening to the monetary privilege that has allowed the United States to run persistent deficits without immediate consequences. As this privilege erodes, the dollar's purchasing power will decline, imported goods will become more expensive, and the inflation already present will intensify. Precious metals respond violently to these conditions because they represent the antithesis of the current system. They are not someone else's liability. They cannot be printed into existence. They cannot be defaulted on through policy decisions. Throughout human history, when currency systems reach their mathematical limits, societies return to monetary metals, not by choice, but by necessity. The 1971 gold window closing, the 2008 financial crisis metals spike, the 2020 unlimited quantitative easing announcement. Each represented a moment when system fragility became undeniable and precious metals repriced rapidly to reflect their role as monetary insurance. The current environment exhibits characteristics more severe than any of those previous episodes. U.S. national debt approaches figures that would have been considered impossible decades ago. The trajectory is not sustainable by any mathematical model that includes realistic growth and revenue assumptions. Yet the system continues because faith in the dollar's reserve status remains barely. That faith is not infinite, it is not guaranteed. And it is actively being tested by the structural forces already described. This is why the $4 trillion reversal matters beyond the immediate price movement. It reveals that large capital, the kind that operates with information advantages and long time horizons, is positioning for conditions where precious metals serve their historical monetary function, rather than their recent role as speculative assets. The difference between speculation and preservation becomes critical in this context. Speculation assumes system stability with price fluctuations. Preservation acknowledges system fragility and positions accordingly. Gold and silver are not investments in a portfolio context when viewed through this lens. They are insurance against monetary regime failure. The volatility itself carries information. In stable systems, prices move gradually, responding to incremental changes in supply, demand, and expectations. In unstable systems approaching transition points, prices move violently, reflecting uncertainty about future conditions and conflicting positioning by participants with different information and objectives. The markets are not whispering warnings, they are screaming them. The $4 trillion reversal in 30 hours, the treasury market dysfunction, the repo market stress, the debt level impossibilities, the geopolitical realignment, the systematic accumulation by central banks and strategic capital. These are not separate events requiring separate analysis. These are connected symptoms of a financial system that has reached the mathematical limits of debt-based monetary expansion. The timeline for how this resolves is unknowable. The direction of resolution, toward either controlled transition or disorderly collapse, remains uncertain. What is certain is that those who understand these structural realities and position accordingly will fare dramatically better than those who assume the system will continue indefinitely in its current form. The warning signals are present. The question is whether they will be heeded. Understanding the problem is insufficient. Action separates those who preserve wealth from those who watch it evaporate. The $4 trillion reversal in 30 hours, the systemic fragilities outlined, the structural transitions underway. These realities demand a response. Not panic, not paralysis, but calculated strategic positioning based on probability-weighted scenarios and risk-adjusted decision frameworks. Volatility has become the defining characteristic of modern markets. Those who treat it as an aberration to be avoided will find themselves perpetually sidelined or worse, entering and exiting at precisely the wrong moments driven by emotion rather than strategy. Those who recognize volatility as the new baseline operating environment can structure their approach to benefit from what destroys unprepared participants. The first requirement is emotional discipline. This is not motivational rhetoric. This is operational necessity. Markets are specifically designed to exploit human psychology. Fear during declines, greed during rallies, the herd instinct that drives buying at tops and selling at bottoms. Institutional capital wins consistently not because of superior information alone, but because of superior emotional control backed by systematic processes. Most participants lose money in volatile markets because they operate without framework. They react to price movements rather than executing predetermined strategies. They adjust position sizes based on recent performance rather than risk parameters. They confuse activity with progress. This approach guarantees wealth destruction over time. Strategic capital operates differently. Decisions are made before volatility appears, not during its peak intensity. Entry criteria are established based on technical levels, valuation metrics, and macroeconomic conditions, not based on whether recent price action feels comfortable. Exit strategies are planned in advance, with profit targets and stop losses determined by position objectives rather than emotional responses to market noise. Consider position sizing as the foundational discipline. In environments of extreme volatility, the size of any individual position must be calibrated so that even worst-case scenarios do not threaten overall portfolio viability or business operational capacity. This means accepting smaller positions than greed would suggest during opportunities, in exchange for the ability to survive inevitable periods of adverse movement. The mathematics are straightforward but rarely followed. A position sized at 2% of total capital can decline 50% without creating systemic portfolio damage. The same position sized at 20% creates catastrophic risk. Yet during periods of excitement or fear, participants routinely violate these principles, chasing returns or attempting to recover losses through concentration rather than discipline. Time horizon selection determines strategy viability. Trading volatile price swings requires different skills, different tools, and different risk tolerance than positioning for structural trends over years. Most participants confuse these approaches, attempting to trade long-term positions or position long-term in trading vehicles. Clarity on objective determines appropriate methodology. For businesses, precious metals serve specific strategic functions beyond speculation. Operational hedging becomes critical when commodity exposure affects cost structures. A manufacturing business using silver in production faces input cost volatility that can destroy margin predictability. Strategic allocation to physical or derivative silver positions can offset this operational risk, stabilizing financial performance regardless of price direction. Treasury management in an era of currency instability requires rethinking traditional cash management approaches. Holding all working capital and depreciating fiat currency guarantees real value erosion. But holding too much in volatile assets creates liquidity risk during periods when operational cash flow requires stability. The solution lies in tiered allocation, immediate operational needs in liquid instruments, medium-term reserves in diversified stable assets, long-term preservation in hard assets, including precious metals. The difference between physical and paper exposure matters profoundly. Exchange-traded products, futures contracts, and allocated accounts provide price exposure and liquidity advantages, but they carry counterparty risk, regulatory risk, and in crisis scenarios may not perform as expected. Physical metal held in secure custody provides genuine monetary insurance, but sacrifices liquidity and incurs storage costs. Strategic allocation requires both, sized according to specific objectives. Gold and silver serve different portfolio roles despite both being precious metals. Gold functions as pure monetary insurance, stable, liquid, universally recognized, with minimal industrial demand affecting its monetary premium. Silver carries higher volatility due to its industrial applications, but offers asymmetric upside potential in monetary crisis scenarios due to its historic monetary role and current supply constraints. A strategic allocation incorporates both in proportions, reflecting individual risk tolerance and scenario planning. Storage and custody decisions carry implications beyond cost considerations. Jurisdictional risk, confiscation precedent, regulatory environment, and physical security all factor into optimal custody strategy. Diversification across locations and custodians reduces concentration risk. Third-party audited storage provides verification. Home storage provides immediate access but carries security and insurance challenges. Now consider scenario planning as the framework for strategic positioning. The future is unknowable, but probable scenarios can be identified and prepared for. Scenario 1. Continued suppression and volatility. The current system persists longer than structural analysis suggests possible through increasingly aggressive policy interventions. Precious metals experience periodic violent swings, but long-term trend remains suppressed. Strategic response. Maintain core positions through volatility, avoid leverage, accumulate during engineered weakness. Recognize this scenario's unsustainability. Scenario 2. Policy response and intervention. Authorities acknowledge system stress and attempt to manage transition. Currency resets, debt restructuring, potential return to commodity-backed monetary standards. Precious metals reprice dramatically but in controlled fashion. Strategic response. Position ahead of obvious policy shifts, prepare for regulatory changes affecting ownership and taxation, maintain liquidity for transition period opportunities. Scenario 3. Market structure breakdown. System fragility exceeds management capacity. Disorderly collapse of debt markets, currency crisis, breakdown of derivative clearing, frozen financial system. Precious metals gap higher, but markets may experience temporary dysfunction. Strategic response, prioritize physical holdings, establish multiple liquidity access points, prepare for extended periods of market closure or restricted access. Each scenario requires different positioning emphasis, but the common thread, having strategic allocation before crisis becomes obvious, remains constant across all scenarios. Once system stress becomes undeniable to mainstream participants, positioning opportunities disappear, prices gap, liquidity evaporates, physical availability constrains regardless of paper price. Strategic capital positions early, accepts volatility as the cost of preparedness, and waits. The coming months and years will separate those who understood these principles from those who didn't. The $4 trillion reversal in 30 hours provided a microcosm of what larger transitions will look like. Violent, fast, favoring the prepared at the expense of the reactive. This is not prediction. This is probability assessment based on observable structural realities. The debt cannot be serviced at current trajectories. The currency cannot maintain purchasing power under continued debasement. The geopolitical order cannot persist in its current form given the active construction of alternative systems. The derivative structure cannot withstand the stress of the underlying instabilities. Whether these transitions occur over months, quarters, or years remains uncertain. Whether they occur through managed policy response or disorderly collapse remains uncertain. What is certain is that they will occur, because the mathematics underlying the current system have reached their limits. Understanding market structure provides competitive advantage in this environment. Those who recognize how institutional capital operates, how volatility is engineered, how wealth transfers occur during crisis periods, these participants position themselves on the correct side of the coming transitions. The choice is individual. Continue operating under assumptions that the system will persist indefinitely in its current form, or acknowledge structural reality and position accordingly. The markets have provided the warning. The $4 trillion recovered in 30 hours was not noise, it was signal. The question is whether that signal will be heeded or ignored until circumstances force recognition at far less advantageous positioning. Strategic capital has already made its decision. The evidence is visible in central bank accumulation, institutional positioning, and the calculated volatility that serves wealth transfer objectives. The framework has been presented, the scenarios outlined, the decision criteria established. What remains is execution.